right, so most investors with a medium to low risk appetite often gravitate towards debt funds, but when opting for market linked instruments. However, the new tax rule in the new financial year have come into play, leading debt investors to revisit their investment portfolio for higher returns. So, should you choose debt mutual funds, fixed deposits, or rather insurance products like a unit linked investment plan, which is ULIP, to gain maximum returns in the debt space? Let's answer all of these questions. We have Sameep Singh, Product Head Investments, Policy Bazaar, with us. Sameep, hi, good evening, and welcome to the show. So, we are going to talk about, in fact, we are going to compare the debt fund in a ULIP with debt mutual funds and a fixed deposit, which are much more preferred and comfortable investment instruments for most of the investors now. Let's just get an overview of what exactly is a ULIP plan, because these plans offer fund options which are equity and debt based as well. It's a product which has a mix of insurance as well as investment. Now, focusing just on the investment part and the fund part of it, what kind of options are ULIP 2.0 or the modern ULIPs offering?
See, ULIPs is a market-linked instrument. It also, just like a mutual fund, and it also has an additional benefit of a life cover associated with it. Now, the biggest benefit of investing in a ULIP, apart from the returns, is that you get up to 2.5 lakhs tax-free returns. So any investment, if you make an annual investment of up to 2.5 lakhs that normal retail investors would do, you would get tax-free returns. That is better than doing a debt mutual fund or an FD. Okay, so I take an example.
Yeah, Sameep, so I want to come to this aspect, but maybe later on in the conversation, in the discussion, because first I want to establish this to our viewer, whoever doesn't understand ULIP or maybe have put money into it wrongly. What kind of investment options you have in a ULIP?
See, ma'am, in a market link plan like a ULIP, basically you, for example, you invest 1 lakh rupees annually. Now you have a choice to make whether you want to invest it in an equity fund, a debt fund, or balanced funds, which are a mix of debt and equity. Now this is up to the customer. Whichever fund he is more, his risk appetite associates with more, he can choose that. Now the returns, see, the underlying asset of both a debt ULIP and a debt mutual fund are the same, and the same applies for an equity ULIP and an equity mutual fund also. For them, the underlying asset is stocks, and for a debt ULIP and a debt mutual fund, the underlying assets are government bonds, government securities, and corporate bonds. So the return will not be very different, apart from the fact that earlier what used to happen was a common misconception that ULIPs are extremely high cost. But with ULIPs 2.0, costs have gone down comparable with normal mutual funds. ULIP costs are as low as 1.25% a year. So costs are down, and the underlying asset in both a ULIP and a mutual fund are the same in the end. So the returns can be comparable.
Sameep, when we talk about equity and debt option, typically what kind of investment instruments are these funds talking about? Where do they put their money? You're talking about stocks or other avenues of equity, and when we're talking about debt, what kind of options are available? Could you elaborate on that?
Sorry?
Could you elaborate the kind of investment instruments, equity and debt part in a mutual fund, in a ULIP plan actually invests in?
So, ma'am, the equity ULIPs invest obviously in stocks. They can be any large cap, mid cap stock like Infosys, TCS, right? So retail investors cannot pick and choose stocks on their own because they'll not be able to identify which stocks to invest in. So a fund manager does it on their behalf. It is similar to a mutual fund. And in terms of, if you talk about a debt fund, there they invest in AAA rated corporate debt or government debt, which is state and central government securities. Basically, the state and central government also borrows, and they issue securities, and the mutual funds invest in them. They are almost guaranteed, or not almost, they're 100% guaranteed the government debt, because obviously the government will not default. The returns keep varying basis on what tenure you have purchased for. So all in all, what I would say is that debt funds invest in government securities and corporate securities, and ULIP and equity mutual funds invest in stocks like TCS, Infosys, different companies basically. Since retail investors cannot do that on their own, these companies, these fund managers do it on their behalf.
Talk about the debt aspect or debt funds in a ULIP scheme, Sameep. Explain us how many times in a year can you actually change this? Can we go from equity to debt, or if at all we've started our investment maybe in equity, we need to continue having the same kind of fund and same kind of exposure to the asset class?
Yeah, see, the biggest benefit is that there is no exit charge when you move from equity to debt or debt to equity in a ULIP fund. So basically, when you invest in a ULIP, there are 8 to 10 funds in that, and these are of different categories. There are equities, there are debt funds, and there are balanced funds. You can switch between the three basis your risk appetite or basis you see the performance of these funds, and you can keep switching. And there is no exit or entry charge in these funds. Whereas if you do that in a mutual fund, multiple times in a year, you might end up paying charges, which are as high as 1% of your returns that you garner.
A debt mutual fund and a ULIP debt fund, what are the similarities? Let's ignore the tax part as of now, but then let's talk about the investment instruments and the avenues. What's the similarity?
The underlying asset class that they invest in is mostly similar. Debt mutual funds might take slightly more risk, and so ULIP funds only invest in AAA rated corporate security and state government and central government debt. Mutual funds might take a bit more risk and might, to give higher returns, might invest in slightly AA rated securities as well. That's the only difference. The underlying assets mostly remain the same.
So now
that is why returns also for these would be similar. That's what I've been trying to highlight.
So now, a ULIP is a product where you have to be invested for long. First of all, it's always recommended that you need to have your insurance and your investment separately. A ULIP is not supposed to be the first preferred mode of investment, because an investment plan through an insurance, which is not a pure insurance plan for you. You might as well have a term insurance and proper life cover with you. But when we are investing in something like a ULIP, and that to a debt plan in a ULIP, is it advisable to stay locked in for a longer period of time? We don't know where the interest rates would be going. Not talking about the current scenario, which obviously signals towards a rate cut maybe later this year or maybe in few quarters now. Typically or generally also, in a debt ULIP plan or a debt ULIP fund, for how many years should one be locked in? I mean, there is a 5 years lock-in, obviously, but then just for tax benefit doesn't make buying it, right? You need to have a medium to long term. You need to have a medium to long term horizon if you are locking in yourself in a product like a ULIP.
See, ma'am, only being stuck in a debt fund, I would not put it like that. See, you can keep switching basis the kind of returns that you see on a year-to-year basis also. I'm not saying lock in your money for 20 years in a debt fund. See, if people want to invest in debt funds, they don't want extra risk associated with equity funds, they can stay invested. But on a year-to-year basis, you can keep changing whichever way the interest rate cycle goes, right? You can keep switching, and there is no exit or entry charge in any of these funds. So you can keep switching between equity, debt, and vice versa, and this is as per your risk appetite.
Means that if at all you want to take advantage of the benefit of the EE status that I think the ULIP has, you need to make sure that your premium doesn't cross 2.5 lakhs.
Yeah, so see, the ULIP has an extra benefit that the insurance companies have, that extra tax arbitrage, I will put it like that, where if you invest up to 2.4, so up to 2.5 lakhs a year. So I take an example. If I invest up to 2.4 lakhs a year for 20 years, so I pay for 20 years and I stay invested for 20 years at a 8% return. See, mutual funds and ULIPs in a debt scheme over 10 years, in the last 10 years, that the average return has been 7 to 8%. So we assume that you get an 8% return. 1% we deduct expenses. So you will make around 1.05 crores. So on the 1.05 crores that you would make, the principal invested comes out to be 48 lakhs. So I gain around 57 lakhs over 20 years. Now, if you invest in a debt mutual fund, on those 57 lakhs, you will end up paying around 17.8 lakh rupees as taxes at a 30% tax bracket. And in a debt ULIP, you will end up paying no taxes. So there, the tax arbitrage is immense, right? And the similar scenario applies to a debt equity mutual fund and an equity ULIP also. There also there's a tax arbitrage of 10%. In a debt ULIP, you will be taxed at your tax slab. In an equity mutual fund, you will be taxed at 10%. So both ways, there's an immense tax arbitrage that everybody should take benefit of and invest at least up to 2.5 lakhs in a ULIP product. They are equally competitive, low on cost, I don't see any reason why you should not do it.
What are your recommendations for ULIP debt fund?
See, my recommendations are that in the last 10 years, how I've seen performances go, the top companies that come to my mind are Tata AIA Life, Birla Sun Life, ICICI Prudential. These have got good debt funds. Returns have been in the range of 7 to 8%. Okay. And see, then again, if you're not comfortable with the return that you are getting and you aspire to get a higher return, you can always switch to an equity or a balanced fund, right? So that flexibility is always there. So we are not saying that you should only stick with the debt fund, but there's a tax arbitrage that you should take complete benefit of.
Thank you so much, Sami, for being on the show and helping our viewers with all the aspects of debt ULIP fund. On that note, let's take a quick break, and post that let's discuss PPF, and also how can you buy a term insurance policy if you have a critical illness. After this break. Welcome back. Life insurance policies and especially term insurance plans are typically easy to obtain for healthy individuals who have no pre-existing medical conditions or diseases. However, getting a life insurance policy may be a little more challenging if you are someone who is suffering from a critical illness. So how can you get a term insurance plan? What is the process? Let's understand all of this with Mahavir Chopra, founder Beshak.org. Mahavir, good evening and welcome to the show. We are talking about people with critical illnesses. How can they opt for a term plan? Because it's a zone which is not very comfortable for life insurance companies, definitely. But some time back, there was definitely no hope for people who are suffering maybe from diabetes or cancer or maybe severe critical illnesses. Can they buy a term insurance plan?
Right. So when you look at term insurance or any insurance product, you should try to draw parallel with taking a loan. Right. When one person takes a loan, there is a credit history or a credit score that a bank will look at before they give you a loan. Similarly, when you're buying a health insurance or policy or a term insurance policy, the insurer is going to look at basically your health history, your medical history, and then basis that understand the risk of how many claims they may have to pay, and based on that they will evaluate whether they want to give you the policy or not. So yes, for people who have a medical history, for people who have, let's say, like you rightly said, diabetes or hypertension, it is much more trickier to get a term insurance policy than someone who's healthy.
Say tricky, what does that mean?
Yeah.
Maybe if we can just start with cancer. Sure.
Yeah. So tricky basically means that you may have to apply to multiple insurance companies. Maybe there could be insurance companies who may not approve for your policy. That is the highest level thing where you could have a decline from an insurance company. The second could be an insurance company could charge you a loading, which is basically called in the insurance parlance, it's called loading. But what it basically means is that additional premium for the higher risk that you have, the insurer could charge excess premium to you year on year. So typically, let's say if the premium is 100 rupees, or let's say for the sake of the example, let's say 20,000 rupees, the premium for someone who has additional risk, let's say of diabetes or has pre-diabetes or let's say hypertension, or even for that matter obesity, right? The premium could be between higher. So if it's 20,000 is for a standard life, for someone who has such kind of illnesses, it could range between 24,000 to 30,000 rupees. So they may have to pay close to around between 15 to 50% additional premium for the additional risk that they have because of the medical history. So that's what I meant by this trickier, that they will have to probably go to multiple insurers and they could also have to pay more premium.
So when we talk about multiple insurers, typically what kind of life insurance companies are we talking about? If you could just lay down the way for these kind of people, someone with even maybe heart trouble, because it's not only cancer, a lot of people also have cardiac issues. Even they find it difficult to get a life insurance policy.
Yes. So for critical illnesses, definitely insurers are way more stringent in terms of giving a policy. And specifically, if the person is, let's say, even at a higher age. Let's say if that person is, let's say, 40 or above, and plus the person has, let's say, a cardiac disease, like you mentioned, a heart disease, or has some very critical illness, which is typically a serious illness. In those cases, there would be multiple insurers who are likely to reject your policy application, largely because insurers are also driven by something which is called reinsurance, where they are under terms with another larger insurance company, mostly in India or abroad, and they basically, based on these terms, need to issue a policy to you. And most of the times, the terms that are there between this insurer and the larger reinsurer that we talk about excludes such kind of profiles. So largely, if there is a serious illness, the chances of getting a policy, like serious illness is basically heart, cancer, or we are talking about a major surgery that has happened. In those cases, the chances of getting a policy are like 1:10. Right? So it's 10% chances of getting a policy. But let's say you go a little lower in the scale of, let's say, the kind of illnesses that exist, and you talk about chronic diseases, which are regular diseases which can be maintained, like for example hypertension, or let's say diabetes, or let's say thyroid. In those cases, the insurer may not decline the policy but may actually charge an additional premium to the policy holder who is applying for the policy.
When we are talking about higher premium, Mahavir, what will be the percentage? And for someone who has a very long medical history, maybe, and if is denied term insurance plan from a lot of companies, what are the options for them now?
Yeah, so the reality is that for people who do not get term insurance, there is no other option available which is as good as a term insurance. Then what you will have to do is that either you have to talk to a financial planner and look at other modes of keeping reserves and savings so that your family is able to take care of themselves in your absence, or otherwise look at some if the requirement is not very high and you want to take a financial cover, then there could be other products like savings products and traditional products that are available with insurance companies, which could provide you a death cover, which could be used, but that has to be used with a lot of care, because the terms and conditions of those policies need to be understood very well. But these are the two options that are available for people who typically won't get a regular standard term insurance and may have to look at options.
Mahavir, now, do you think it's always advisable to have a rider along with the term insurance? If at all someone has a critical illness right now, can they get a cover, or it's advisable to just buy a comprehensive policy?
Yeah, so if a person already has a critical illness, the chances of an insurance company giving a critical illness rider is almost zero. No insurance company typically will give a critical illness cover to someone who already has a critical illness. So that is one. And on a general basis, if you're talking about riders, I think riders are an excellent part of an insurance product which allows customers to customize their policy based on their needs. So typically, the only suggestion we have to people who are right now young and healthy and don't have any diseases or issues is that they should, first of all, buy a term insurance quickly so they don't have to pay large premiums, loadings like we spoke about. And second is that ensure that they buy such riders, typically, let's say, even a critical illness rider, so that in the long run they are covered, A, and B, if they are looking at it later in their life when they have a disease and they don't find it, that is a risk that you can mitigate. So from that perspective, it is very, very important that as a young age, you should basically ensure that you have taken care of these things. And people right now listening to this video are able to understand that how difficult it can be if you have a disease and then have to buy a policy.
Do we have the kind of term insurance policies where there is an option to opt a coverage for critical illnesses?
Yes. So almost all term insurance policies have an additional rider option available where you pay additional premium and you can get cover for critical illnesses separately. So what does this cover is that basically if there is any kind of critical illness that happens, then the insurance company will pay a lump sum amount to this policy holder or its family for that diagnosis of that critical illness. This is different, obviously, from a death claim where there is a death that happens due to critical illness, which is anyways covered in a term insurance. So, term insurance covers all deaths, all kinds of deaths, apart from first year exclusion on suicide. So, it will cover you for critical illness related deaths also. Critical illness rider is an additional rider which will pay you for a critical illness diagnosis that has happened before, obviously, a death, and it will pay the family so that they can take care of the medical needs, the loss of earnings that happens because of a serious illness.
All right, so that's the way ahead. Thank you so much, Mahavir, for being on the show and helping our viewers with all the aspects of buying a life insurance policy along with the critical illness rider.
Thank you, Karan.
On that note, we'll take a quick break, and post that we'll talk about PPF. In fact, all the questions which are never asked about PPF will be discussed today along with your portfolio-related queries, and I'll be having Harshvardhan Rungta with me after this break who will do your life financial planning as well. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. So when it comes to investment in fixed income spaces, Public Provident Fund or PPF continue to be preferred investment option for most Indians. So why is PPF such an attractive option for investors? What are the tax benefits associated with PPF? Can NRIs invest in PPF? Let's understand all of this with Harshvardhan Rungta, CFP Rungta Securities. Harsh, good evening and welcome to the show. So not only there's this tax benefit, but also the benefit of EEE, exempt, which is really huge for a lot of people, especially those who are scared of volatility and want safety and security when it comes to their money and the money they earn on their money. But people are aware about the basic instrument features of PPF, which is there is a lock-in for 15 years. The minimum investment amount is almost 500. That can go up to 1.5 lakh, and based on which you can get tax benefit if you are investing as per ATC. And after 15 years, the money that you earn out of it is exempt. It's totally tax-free, and the current rate of interest we know is 7.1%, which is reviewed every quarter. But let's talk about what else does PPF offer you. My first question to you is the loan that you can take on your PPF corpus, or the amount that's invested right now, even if the 10 or 15 years is not completed.
Yes, so you're right, Kavita, that PPF is indeed one of the most popular debt products that investors can have. So just to give you a before coming to your answer as to your question as to how much loan can you take, etc. So PPF was introduced in 1968, and ever since then, it has been one of the most popular debt investment that individuals could make, and primarily so, I mean, because besides the points that you mentioned, which was that the interest is tax free. It's a safety that the government of India is kind of offering you on this. One most important factor is that it cannot be attached by any court order. So if there is any debt or liability on the account holder, I mean, even if there is a court order on attachment of properties, PPF is being left out of this purview. So that makes it a little more secure in terms of the personal assets that a person can own. Now coming to liquidity, yes, it's a 15-year deposit, which can be renewed in blocks of 5 years once it is mature. Now, however, in case people need money, in case there is a need for money, there is an option to take a loan from the 3rd year to the 6th year. So if you're in the 3rd year and between the 6th year, then there is a loan facility available which you can take against your deposits. Now that loan will be subject to a maximum of 25% of the balance that you have 2 years ago. It's a little complicated stuff, but let's not get confused with those details. In principle, to say that there is a facility to take a loan, which is between the 3rd year and the 6th year. The amount that you are eligible to take loan upon is a value which is 25% maximum, subject to whatever the balance was 2 years prior. Post 6 years, you can also take partial withdrawals. You can make a partial withdrawal into this. There is some kind of liquidity that is available in the form of loan, and even in case of partial withdrawal. However, there is a limit on which you can withdraw, which is pretty less in that context to the balance that you will have in your PPF account.
What will be the rate of interest?
Okay, so if you're taking loan, the rate of interest is 1%. Okay, so the interest is 1%. However, the period until you've taken a loan, there is no interest that you're going to be paid. So effectively, whatever is the interest rate on PPF plus 1% is essentially what your cost is going to be for taking the loan.
Now, what is the duration for the repayment? Do we or that amount will be deducted from your investments per year or however you are making in PPF?
No, so there is a payment that you have to repay it within 3 years, if I'm not mistaken. You have to repay
36
the
months,
loan
yeah.
within 36 months. You have to repay the loan, and the interest also needs to be paid. So the 1% additional that has to be paid. So very important to note that while your loan is outstanding, you will not be paid any interest on your deposit. So that's your kind of cost that you're paying. It's interest rate that you have on your PPF account that you're earning plus 1%.
Partial withdrawals that you mentioned, Harsh, are they subjected to certain conditions?
Yes, like there is a withdrawal, like there's an eligibility for loan amount. There is a limit on the withdrawal that you can make in the form of partial withdrawal.
And that can be on specific conditions, or you can just, do you have to really mention the reason why you're doing this partial withdrawal? There has to be some kind of emergency attached to it?
No, not really. So if you have a balance in the account, you're eligible to withdraw without giving any specific reason. And it's unlike an NPS that you can withdraw only under certain circumstances. Here, there is no such restriction. Yeah, and you can just withdraw, but the eligibility of the amount is going to be very restricted in terms of the quantum out of which. So even if you have 10 lakhs in your PPF account, does not mean that you can withdraw 10 lakhs for partial withdrawal. There is a formula which makes the eligibility pretty restricted. However, there is a partial withdrawal option available.
Also, Harsh, after 15 years, if I still continue to put money in a PPF, will I still get the tax benefit? And what will be that tax-free period window available for investing then? For how many years?
Okay, so once your PPF matures, you have an option to renew it for a block of 5 years. So every 5 years, then you can continuously keep going on. So once 15 years are done, you renew the PPF account for 5 years. You don't have to remove the balance that you've already accumulated, so that you can leave it as it is. When you renew it, the entire balance continues to get the earn interest on it as per the interest rate as may be applicable on that day, in that quarter rather. And you can contribute, the same rules apply, that 500 rupees is minimum up to 1 lakh, 1.5 lakh.
Citizen invest in PPF, Harsh?
I'm sorry, I missed your question. Can you repeat your question?
Senior citizens invest in PPF? Is there any age limit or age bar? Okay.
No, there is no such age limit. In fact, there is one important category of investors who have this question, like, can NRIs invest into PPF? So, because many people, while they opened the account, they were resident Indians, and then they moved overseas to become NRIs. So there is a specific provision which says that when you opened your PPF account, at that point in time, if you were a resident Indian, and then when you became an NRI, so in that case, you can continue investing into your PPF account until the 15 years get over. So on maturity, thereafter you cannot renew your PPF account because you're an NRI in the form of your residential status is NRI. However, as I said again, once you move out, your residential status changes. But when you open the account, you are a resident Indian. So you can continue depositing in that account as well. If you want to open a new PPF account being an NRI, you cannot do that.
How many PPF account can a person actually open, and do we get tax benefit for each of those accounts?
So technically, you cannot open more than one PPF. So you cannot have more than one PPF.
I mean, some people do it in the name of a minor, or people do it in the name of their wives or their spouses. Can that be done?
So each individual who's a major, so husband, wife, each individual will open their own PPF accounts. If there is a minor, then the minor has to open a PPF account under guardianship of the parent. So say, for example, the father and the child has a PPF account separately. The child has an independent PPF account. The father has an independent PPF account. Now, both accounts put together, there is a limit of 1.5 lakhs. So you cannot put 1.5 lakhs in the name of your minor child and 1.5 lakhs in your name. So both put together is 1.5 lakhs. And many people I know have been investing in the child's name of 1.5 lakhs, even in their own name 1.5 lakhs. That's not allowed technically. And the mother, father, all adults, all majors can have independent PPF accounts. And if you're investing, say the wife is a homemaker you can still invest into the PPF account of the wife. It need not be necessary out of income generated by her, on her own income. You can invest into her PPF account. You can invest into the husband's PPF account and the minor, but whoever is the guardian in the minor's account, that guardian plus minor should have a maximum investment of 1.5 lakhs in a year.
All right. So these are all aspects which are mostly never discussed about PPF and very crucial for an investor to know about. We move on and we have our first viewer on phone line with us, and that is Mr. N.V. Chandrasekhar from Hyderabad. Good evening, sir. How are you doing? Okay, so you have quant mutual funds in your portfolio?
Yeah, that's right. I invested in quant multi-asset and absolute funds recently.
Sorry, I did not get the name.
Bigger portfolio.
I did not get the name of the quant fund, sir. Can you repeat it, please?
Pardon?
Can you repeat?
Yeah, I have invested in this quant mutual fund.
What are the schemes' names, sir?
The multi-asset and absolute fund.
Right. Do you have the fund's name on you? This is the fund house's name. Multi-asset is a category.
Multi-asset, one fund.
Quant multi-asset.
Absolute fund is another.
Quant multi-asset and?
Quant absolute fund.
Quant absolute fund. Okay.
Yes.
Okay. Okay.
Actually, I have invested in, I'm not telling you about my other bigger portfolio, but I want to know why these quant mutual funds are going down nowadays. These two funds are doing very badly, and is it okay to continue in these two funds?
So this is just 6 months back you invested, right?
Yeah, still some 8 months I've been investing in this, but they're doing very badly.
6 to 8 months. Is that what you're saying?
Yeah.
Okay. Got it.
All the other funds in the same category are doing better than these funds.
But why do you have the same category of funds in your portfolio then if you already have this category fund?
Just for diversification.
So for diversification, you should be going beyond these categories. No, I would request you to send the other portfolio, other funds also later on. But right now, let's just talk about quant multi-asset and quant absolute fund. Harsh.
Yeah.
Harsh.
Yeah, so Kavita, one, I don't have the query with me, but you are, of course, trying to get the names of the schemes. If I've understood correctly, it is quant multi-asset and a quant absolute fund, right?
Right, and he invested. Right, and he invested almost 6 months back. That's what he's saying, and he's unhappy with the fund's performance as compared to the peers right now.
Okay, so two things on this. One is the quant has a very momentum kind of investment strategy. Okay, so they don't really follow the traditional long-term investment theories like a growth or a value. They're more like a momentum and timing the market kind of an investment philosophy that they have at the fund house. Now, with regards to the two schemes, both schemes by themselves are good. I don't see a reason why he should be worried about the performance in 6 months. Within their category that they're doing, the multi-asset and the absolute, both are good in their category in terms of their performance otherwise. So I think it's a little too early for him to think as to why the schemes are not doing well. It's just been 6 months. So give it time in that context. Now, coming back to the original and the first point that I made, their investment philosophy you need to understand. They're not, typically the traditional investment fund managers. So if you're not comfortable with their investment strategy, then you will need to change. If you're comfortable with the strategy and not happy with the performance right now, then you can ignore and continue with the fund.
All right. Thank you so much, Mr. Chandrasekhar, for sending us your query. We move on. And do I have my other viewer on the call with me, Aditya Khurana from New Delhi?
Yeah.
Hi, Aditya. Good evening. How are you doing?
Yeah, I'm doing good. How about you?
I'm doing good. Thank you so much. So you have Nippon Growth Fund, you have HDFC Balance Advantage, Axis Blue Chip, Axis Small Cap, Axis Nifty 50, ICICI Infrastructure, ABSL, PSU Equity Fund and Kotak Tax Saver, right?
Yeah, that's it.
And your investment time horizon is?
I don't have a time horizon, so it's a long-term thing.
Okay. You just got this portfolio done for yourself?
Yeah, actually, I had help from my father, but I just wanted to know if it's strong enough to create wealth in the long term.
Okay. Since it's not tied to any goal, Harsh, how would you like to analyze these funds?
Okay, so apparently, Kavita, I'm just trying to get up to speed to note down the schemes that he has with him. So it's Nippon Growth, HDFC Balance Advantage, Axis Blue Chip, Kotak Tax, ABSL, PSU. That's the names I could gather. So one very clearly not having a time horizon will only try and give you. We don't really know where are we heading towards. Now, if you require this money in the short term, then of course the portfolio is going to be very different. Now, assuming a fact that the investments are going to be over long term, okay, that's the first part. Only then can you take a view on equity because he has an Axis Blue Chip, he has ABSL, PSU, Kotak Tax Saver. So these are pure equity, Nippon Growth. So these are all pure equity funds. So the minimum time horizon that he will need to keep with himself is between 8 to 10 years at least. Now, if that is the case, then of course the investments can be made into equity. Now, asset allocation point of view, I can say that you have 80% kind of investment into pure equity funds and 20% would go into debt. Debt would include some portion of debt allocation in the HDFC Balance Advantage Fund as well. So your Axis Nifty 50, ICICI Infra Fund, Axis Small Cap, these are very, very aggressive equity funds. So Aditya, you need to be very clear as to what is the minimum time horizon. You may not have exactly how long can you be invested, but at least have a view as to what is the minimum time horizon that you can stay invested. If it's 8 years from now or 10 years from now, then equity allocation is fine. I think you should send the query again to us post having some clarity on how much is the minimum time horizon that you can stay invested. Second element, you really have a lot of schemes in your portfolio. You really don't need so many schemes in the name of diversification. You have a sector fund, you have a PSU fund, you have a small cap, large cap, and in the large cap, you have an Axis Blue Chip and Nifty 50 again. You need to consolidate. You don't need both of these schemes in the large cap. You just have a Nifty 50 and that is good enough to have representation of the large cap. So I think you'll need to do a total rework and probably come back again with your query with little more specifics as to what you're looking at, how you want the asset allocation. Because if you give me that information, then probably we can design something for you.
There on the phone line with me, do you want to ask Harsh anything? Okay.
So if my minimum time horizon is if I say 10 to 15 years, so how can that be analyzed?
Okay.
Yeah. So no, that is a good point that you made, Aditya. So if you're saying 10 to 15 years, then I would say about 80% of whatever you're investing every month. So you have 5,800, I can see 5,300, 3,200. I really don't know how you got these amounts also. Usually we see investments which are in round figures. I mean, it could be either 6,000 or 5,000 or 3,000. But nevertheless, whatever be the reason, it's not that you cannot do it. Your total monthly investment, take about 80% of them and park it into pure equity funds. Now, within the pure equity funds, if I can give you some recommendations right now, Nifty 50, Axis Nifty 50 that you have with you, invest about 30% into that of the total investment that I'm talking about. You can continue with Nippon Growth, Axis, ABSL, PSU, and Kotak Tax Saver, because these are what you already you need a tax benefit under Section 86. So you can continue with Kotak Tax Saver. On the 20%, you can just invest into the HDFC Balance Advantage Fund. So I think this will consolidate your portfolio into about 5 schemes, and that should be good to go.
All right, that's all. Aditya, all the best with your investment portfolio. Harsh, we move on to our next question, which is from Srinivas Kadiyala. And Harsh, the question is on HDFC multi-cap fund, and he wants to know that can he start his SIP in this fund, and is multi-cap a good category for him?
Yeah, so coming to the multi-cap category first, Kavita. So what does a multi-cap category do? So as per the mandate, they are supposed to invest 25% of their corpus in all 3 segments, market segments. So you'll have a 25% allocation to large cap, you'll have a 25% to mid cap and 25% to small cap. So that is a mandatory allocation that has to be done. The balance 25% can be invested into any of the three categories, however the fund manager feels comfortable investing with, and wherever they find opportunities. So with regards to multi-cap category, it's a good category to be into. You get representation across the market segment. Now, with regards to HDFC multi-cap, so HDFC as a fund house is one of the top performing fund houses overall. So I'm not talking about only one scheme. I'm talking about the assets that they manage, equity assets. As a whole, their performance is definitely above, the category, above the mutual fund industry average. So it speaks a lot about the fund manager. So most certainly you can trust upon this scheme in terms of the multi-cap as a structure and the fund house, which is HDFC, and you can most certainly start investing into that.
I think that will be all for today. Thank you so much, Harsh, for being on the show and helping our viewers with their financial portfolio queries. And on that note, it's time to sign off, but I'm going to leave you with our WhatsApp number and email ID where you can reach us and send us your portfolio-related queries. The email ID is themoneyshow@etnow.tv and the WhatsApp number is 8657974571. Thank you so much for watching. Goodbye.